If you are wondering what the ATO thinks of crypto holdings or whether you should be paying capital gains or income tax, here's what you need to know. Hi, I'm Krishan Sharma, founder and director of NDIS Accountants. As a team, our goal is to provide you with the necessary information to understand your financial position and make the best decision for your business. There is no doubt that the world of cryptocurrency and NFT is taking the world by storm. And I'm not surprised. It seems like Bitcoin and NFT collections are here to stay. So, on a less exciting but an important note, if you have bought or sold cryptocurrency in the last financial year, it's time to start thinking about the impact this may have on your income tax return. In today's video, I will share the basics of cryptocurrency tax in Australia to help you learn what you need to do to keep the ATO in your good books. We will also have a look at how tax applies to NFTs. Before we start, it is important to note that this video is intended as a guide only. It should not be seen to constitute legal or tax advice. You should, where necessary, seek your own advice for any legal or tax issues raised in your business affairs. Okay, let's start with a quick rundown of when cryptocurrency is taxable. The profit you make from cryptocurrency is determined in Australian dollar amounts when you exchange cryptocurrency for a fiat currencies, other cryptocurrencies or goods and services. For example, if you bought or acquired one Bitcoin worth $3,000 and then sold it or spent it all when it was worth $10,000, you would likely to incur a tax obligation on the $7,000 profit you gained. The profit is taxed depending on whether you are a trader or an investor. According to the ATO, a person is considered a trader if their primary goal is to earn an income from buying and selling various cryptocurrencies. In this case, a trader's crypto profit may be treated as equivalent to personal or business income and therefore subject to relevant type of income tax. Some example of a trader's business activity would be professional crypto trading, commercial crypto mining, or business-related cryptocurrency transactions. If you are a professional trader who buys and sells cryptocurrency for profit, the profits you make from the part of your assessable income, this means that you may be able to claim deduction on your trading expenses. On the other hand, if you are buying and selling cryptocurrency to experience long-term capital growth, then you will be likely considered an investor and your profit will be considered personal investment gains and will be subject to capital gain taxes instead. This is because the ATO classes digital currency as property as an asset for capital gain tax purpose. Some examples of investor activities would be buying cryptos for yourself, mining cryptos as a hobby, or casually trading cryptocurrency. So now you know the different ways you can get taxed. Let's get some examples when capital gain tax applies. A CGT event occurs when you dispose of any cryptocurrency. For example, if you sell, gift or exchange cryptocurrency for another crypto or fiat currency, that will trigger capital gain tax. Likewise, if you convert your cryptocurrency to fiat currency like Australian dollars or use it to obtain goods or services, then you will have to pay capital gains as well. However, if you hold your cryptocurrency for more than 1 year before selling or trading it, you may be entitled to a 50% CGT discount, and even if the market value of your cryptocurrency changes, you don't make a capital gain or loss until you actually dispose the holdings. On the other hand, if the proceeds from the disposal of the cryptocurrency are less than what you paid to acquire it initially, that will be considered a capital loss. Capital losses can be used to reduce capital gains made in the same financial year or a future year, including investment outside of cryptocurrency. It is also worth considering that crypto-to-crypto trades also trigger CGT. In other words, if you exchange some of your Bitcoin holdings for Ethereum token without ever converting any of your funds back to Australian dollars, you will have to keep a record of transaction for capital gain tax. Thankfully, there are situations where you won't be taxed. For example, you may be eligible for personal use asset exemptions. So, if you use crypto to purchase goods or services for personal use, such as booking hotel online or shopping at retailers and spend less than $10,000, you won't have to pay capital gain tax on the transaction. This is quite a basic outline of tax on your cryptos. So if you need help working out your crypto tax classification, or if there's a situation that we have not mentioned in this video, like if your cryptos are stolen, we recommend to seek professional advice from a crypto tax specialist. Before we end the video, let's have a quick look at how NFTs are taxed. NFTs store additional information which makes them work differently from standard coins. However, in terms of tax treatment, the ATO has stated that NFTs follow the same principles as cryptocurrencies. Because of the complex nature of crypto and NFT transactions, you must keep detailed records of your transaction regardless of whether you are an investor or a trader. Your record should include the date of each transaction, the value of the cryptocurrency in Australian dollars at the time of the transaction, and the purpose of the transaction, and the detail of the other party involved, even if it is just their crypto wallet address. So that's everything in a nutshell. Besides the complexity around the crypto tax, there is still much we don't know for certain about how the ATO will treat cryptocurrency. So getting advice from an accountant or registered tax agent is the best way to make sure you don't end up with a big headache come tax time. I hope you find this video helpful. If you did, make sure give it a thumbs up and stay tuned for all our business accounting tips and tricks. See you next time.